Next is statement of P&L and other comprehensive income. In IFRS, we have a choice that we can use single statement approach or dual statement approach. In a single statement, we can present P&L as well as comprehensive income, other comprehensive income, or in two statements wherein we present income statement into two parts. One is showing only P&L for the year and one is showing statement of comprehensive income in two statements. IFRS gives a choice. IndAS wants only one statement to be published. There's no choice in IndAS. So either on the basis of nature of expense or function of expense, there's a choice. IndAS wants only nature of expense. If function of expense is followed, nature of expense is required to be disclosed. So we didn't get into it, and we said that only we need only one way of presenting it, that is nature of expense. Additional headings and subtotals can be added if relevant, and there is no concept of extraordinary items in IFRS. Everything is equally prominent as far as IFRS is concerned or IndAS is concerned. And we'll disclose what is attributable to owners and what is attributable to non-controlling interest. Non-controlling interest is a term used for minority interest in IFRS. So we need to appropriate the profit belonging to the owners and belonging to NCI. What are components of other comprehensive income? If you look at, there are limited number of items in other comprehensive income. There is a separate statement. So it begins like this. Income statement, revenue, cost of sales, gross profit. Just for my ease, I'm taking function of expense methods here. Admin, administration, finance, distribution and selling, profit before tax, taxes, and profit for the year. Profit for the year gets added to retained earnings under the head equity. The same statement begins with profit for the year, and in it there are items of other comprehensive income. Other comprehensive income. In other comprehensive income, there will be gain on revaluation, unrecognized actuarial gains or losses, exchange difference on translation of financial statements. Other term, it is known as foreign currency translation reserve. There will be debt instruments. Debt instruments measured at fair value through OCI. Equity instruments measured at fair value through OCI. Now, in a layman's language, if I talk about a layman trying to understand the difference between P&L and OCI, P&L is something which is in the control of the management. They can control how much revenue they can generate through their efforts, the cost of sales, admin expenses. They can manage their distribution and selling expenses. This is something in control of the management, but there are some items which are not in direct control of management, like revaluation surplus. If there is a property which was bought in 1927 for 5,000 bucks, and if I revalue that property in 2019, what will be the value of that property which is worth 5,000 rupees, which was bought in 1927? What will be the value of that property? The value of that property may be 200 crore. If I do revaluation exercise, there is a gain of how much? 199 crore, 99 lakhs, 95,000. Can I show this entire gain as part of my P&L, profit for the year? Can I show this entire gain? Even our Prime Minister will visit us that
No.
you have been very successful manager and you have brought so much gain to the firm. What to do? What to do if I show it as part of my profits for the year? My company will be really profitable if I revalue the assets.
Yeah, it's very inflated way of showing your P&L. It's not the true picture of
It's
your.
not the true picture. So the way out is that if there is any gain on revaluation surplus, we show it as part of revaluation reserve under the head other comprehensive income. We show it separately. Okay. In similar fashion, there is unrecognized actuarial gains and losses. That you have pension benefits to be provided to employees, and there are 5,000 employees in the firm. And how many of the employees will remain with the firm, or how long they'll remain, will depend on demographic assumptions, mortality rates, life expectancy rate in the country, and what is the last drawn salary they're going to draw when they leave the firm. These are all post-employment benefits. So there are some service costs, interest income, which you are able to recognize it through your P&L. And there's a value given by the actuary, fair value of the planned assets and fair value of the planned assets at the beginning of the year and fair value of the planned assets at the end of the year is all given by the actuary. And you are able to do accounting for some of the costs, some of the incomes in your through P&L. But even then there is bound to be a difference between the fair value of planned assets even after doing your accounting, and when you get the fair value of planned assets from the actuary at the end of the year, there is some difference which remains. Either the liability increases or either the liability decreases, or either you get more income from your assets than you expected at, or the funds you have kept separately for contribution into the planned assets are more or less. You're able to do some accounting, but there is one component which remains unrecognized. You could not recognize it. That unrecognized actual gain or loss is not in control of the management. So IAS 19 employee benefit says that this has to be shown as part of OCI. Unrecognized actual gain and loss has to be shown as part of OCI. You got it now? That something which is not in direct control of management and which may inflate the figures, there is a cushion known as OCI. We can direct accounting to OCI and show it as part of OCI. Exchange differences on translation of financial statements. Translation of financial statement means that you have been preparing financial statements on IndAS, but your parent entity is in US. They demand that you convert all the IndAS financial statements based on INR, and suppose your parent is based in Australia, they are using ANZ-FRS, and there's minor difference between these two, and you converted it to ANZ-FRS into INR, but the requirement is that you have to convert it into Australian dollars. When you convert it into Australian dollars, there's bound to be an exchange difference between Australian dollar and INR. Who is responsible for this gain or loss on exchange difference? Is the management responsible? They were profitable in INR and suddenly they ran into losses because they converted the financial statements into Australian dollars. Or they were running into losses, they became profitable, or the profits have decreased, or the losses have increased. Could be anything. Who is responsible for this exchange gain or loss? On translating means converting the entire balance sheet from INR to Australian dollar, converting the entire income statement from INR to Australian dollar. If there is a difference, who is responsible? No one. You cannot blame the management for these differences at least. So the foreign currency translation reserve forms part of other comprehensive income. Then under the standard financial instruments, there are some debt instruments which are designated, which are mandatorily required to be mandatorily measured at. There is a category which I'll discuss in detail when I'm discussing financial instruments. There is a category which is of debt instruments which is mandatorily measured through OCI. It is solely payments of principal and interest category with the intention to sell. That you are going to receive contractual cash flows, you are measuring it at amortized cost, but you intend to sell. You are not going to hold this investment till maturity. If you are not planning to hold this investment till maturity, you may sell this investment. You are required to mandatorily show it as part of fair value through OCI. Take the difference to OCI at the end of each year. You need to measure it at OCI, fair value through OCI, take the difference to OCI at the end of each year. Equity instruments are normally measured at fair value. Normally measured at fair value. Normally at fair value through P&L. But under IFRS 9, we can designate them to be recorded as fair value through OCI item. If we plan to hold this investment for a longer period of time, we have a choice that we can designate it through fair value through OCI. Another reason is that if you are recording an equity instrument under fair value through P&L, the equity instruments are going to get fluctuated at the end of each year. Looking at the normal market scenario or the current market scenario in India, if you notice, there's a lot of fluctuation in the market. And if you are taking the difference to P&L at the end of each year, all your equity instruments may result in heavy losses or too high gains because of difference in market, because of volatility in the market. If you wish to get away from this volatility and if you wish to hold this equity instrument, if you're holding it for trading, definitely you will end up selling it and realizing it in cash. But if you plan to hold this equity instrument for a longer period of time, and if the longer period is 10 years, every year your P&L will get impacted because of the difference in equity instrument, taking it to P&L at the end of each year. So you have a choice under IFRS 9 that you can designate it through OCI. It acts as a cushion. So your P&L will not get impacted because of it, but your OCI will mention that there is a change in fair value of equity instrument. Clear? What else do you think is not under control of management? Anything I've missed which you think can form part of OCI, should be forming part of OCI? Changes in revaluation surplus, OCI. Actuarial gains and losses, I've already discussed. Gains and losses arising from translation of financial statements, I've discussed. Gains and losses on reimagining equity instruments, designated. Designated means there's a choice under IFRS 9. And effective portion of gains and losses on hedge instruments. Under IFRS 9, there's one more requirement, that effective portion of cash flow hedge of OCI. Hedge accounting is voluntary. If you're following hedge accounting and if you're by chance into hedging of a cash flow, there is ineffective portion as there is effective portion. The ineffective portion will form part of P&L, but the effective portion will be forming part of OCI. There are limited number of items in other comprehensive income, nothing beyond them. Once you understand them, you'll know the difference between P&L and OCI. Any doubt in this? Apart from this, it is further classified into what can be reclassified to P&L and what cannot be reclassified to P&L. What do you think can be reclassified to P&L? If this foreign subsidiary, which has foreign currency translation reserve, if I sell it, will I be able to adjust it into P&L because I'll be recording the gain or loss on disposal of that subsidiary as part of P&L? And if there is any FCTR relating to it, can I redirect it to P&L now if I dispose it off? What do you think?
Yes, you can.
So this FCTR on disposal can be reclassified to P&L. Gains and loss on equity instrument can never be reclassified to P&L. Effective portion of cash flow hedge on settlement can be reclassified to P&L if it is finally being settled in P&L. And if there is a debt instrument, if there is a debt instrument which is mandatorily measured at fair value through OCI, on settlement, this is reclassified to P&L. On settlement, reclassified to P&L. Equity instruments designated at fair value through OCI, never reclassified to P&L. Settled in equity. Even on settlement of these equity instruments which are designated through fair value through OCI can never go to P&L because they are equity instruments. You can show the gain or loss or difference directly as part of equity, no requirement to show it as part of P&L. Makes sense, I guess. If it is an equity instrument measured at fair value through OCI, it should show or be part of equity. There's no reason, I think, to show it as part of P&L. Makes sense? Agree or not? But if it is a debt instrument, we are settling at any gain or loss on it. If it goes to P&L, it will be reclassified to P&L on settlement. So there are some items which can be reclassified to P&L. Reclassification adjustment can arise on disposal of a foreign operation, on de-recognition of debt financial instrument, and hedge forecast settled. Hedge accounting done. If it is settled, then these three cases we can do reclassification. But these are the cases there can be never reclassification. That is, investment in equity instruments which are designated through fair value through OCI, actuarial gains and losses and revaluation surplus can never be reclassified to P&L.
When you say settled at equity, like these things, what do you mean settled at equity? So like,
It means if you sell it by chance.
So if you sell it and then if there is a gain, then
that will be forming directly part of your OCI.
Okay, but in India we don't show OCI, so then that
in India we follow IndAS and we show OCI now.
You said that we show only one statement.
One statement means that we present P&L separately, statement of comprehensive income separately.
Okay, whatever.
One statement means you are showing P&L and other comprehensive income in one single statement.
Okay.
Clear?
All right.